Welcome to the Value Investor TV podcast. This is a podcast that helps you grow your wealth and become financially independent. My name is Becco, and my partner Hari. This is episode 36. We're continuing on our conversation in doing a deep dive into a company called Skechers. In the previous episode, we talked about the business aspect of Skechers. Again, we're following Value Investor Checklist. If you don't have it, please do email us at info@valueinvestor.org. In this episode, we're going to talk about Skechers financials, its management, and its valuation. These are the last three chunks in the Value Investor Checklist. So we'll go down the checklist today. So let's do a quick deep dive into financials.
Yeah. So when we talk about this, I don't think we need to spend a lot of time reviewing detailed financials. I think the main thing that we need to kind of look at is are the financials going to derail the company, right? And so do they have enough cash on hand? So Skechers is a $4 billion company in terms of revenue,
Yep.
$4.5 billion or so for the last trailing 12 months, and they have about $900 million in cash, $950 million. So they've built up a huge cash balance over that period of time. And when you think about that, that should be, they're a $3 billion company, roughly. So they have a huge cash, balance at this point.
$3 billion in market cap?
Yeah, $3.5 billion or so. 150 million shares times $25. So $3.5 billion, something like that. Yeah. So $950 million is a fairly sizable war chest, right? And they have almost no debt, like $75 million in debt. So I think they have enough money to actually be shareholder friendly with that, which they've started to do a share buyback. But I think they could be more aggressive with that share buyback. But regardless, maintaining reasonable debt levels, I'm not concerned about, debt, derailing their ability to continue to grow, right?
Yeah.
But so then it really comes down to, do they generate good cash, good cash flow? So we talked a little bit about this in the last episode,
Yep.
that if you look at their free cash flow, the way we're interpreting this is about, 2018 or 2017 was a little bit of an anomaly in the way that you look at it. So if we look at it over a longer period of time, I'm estimating about $350 to $375 million in cash flow from operations, and we had talked about $50 million in maintenance capex, right? We want to take out, so to get our free cash flow number, we want to use maintenance capex, not growth capex. So I'm going to call it $70 million, just because it's hard to tell, what is maintenance and what is growth.
Yeah.
They spend about $100 to $120 million in capital expenditure. So we'll say $50 million of that is growth and $70 million is maintenance, just to be more conservative in our numbering.
Can I just add one note there?
Yeah.
You said $70 million. Hari's saying it's a conservative measure because the management talks about in 2017 10K, they say 45 to 50 million is a maintenance capital expenditure. So Hari's overshooting and saying 70 million. So go ahead.
So if we do that, we have about 270 to 290 million in free cash flow. So I'm going to go with 270 for our calculations when we do our valuation. So roughly, so what does that translate into? So we'll do the valuation here in a second, but let's remember that kind of number, about 270 to 290 is where we're aiming at in free cash flow for. And notice I'm not giving you a definite number, because I can't give you a definite number because I don't know exactly what maintenance capex is.
Exactly.
And cash flow from operations is kind of yearly affected by, they were paying, tax rates and things like that were one-off. So,
yeah, I want to say one thing before we move on. Hari mentioned in 2017 number was a little bit off. So if you look at the financial statements, and if you look at cash flow, the net cash flow from operation, it was at 350, 360 in 2016, and it drops to 150 something And in 2015, it was 200 something. So it was steadily climbing from 230 to 350, and you're projecting a number that's higher than 350. But if you look at 2017 number, it goes down, and that's because that's one-off that Hari's talking about. That's the tax that they've been hit with. So you got to take those into account.
Yeah. So also to be clear on that one is they had, because of the timing of inventory shipments, they had a much higher outflow spend on inventory in 2017 that lowered that cash flow number. So if you kind of normalize those numbers, that's what we're doing here.
Yeah.
Which is why when I see a lot of people do this, and it just to stand on my soapbox for a minute, when you use numbers like this directly from websites and things like that, they are not normalized. They are just what is reported, and there's no story behind it. That's why you use the annual report numbers, because then you can kind of say, oh, it was down this year for one-time reasons, and it was up this year for one-time reasons. So let's normalize it to what it would be over a longer period of time. Maybe you average it, so depending on the scenario. So
yep, exactly.
All right.
Let's move on to, so that was the financial aspect of it, and we talked about the strong free cash flow levels.
Yep.
So should we move? So again, we talked about the debt level as well here, saying that Skechers has pretty controllable amount of debt at this point. When you talk about the cash balance they have of excess capital of $950 million, that's it's quite a bit compared to the debt level of 2-digit millions.
Right.
Okay, let's move on to the management side of things. Unless you have anything to add in the financials.
No. Yeah, I think let's move on.
Yeah, we'll talk about the valuation at the end of the checklist, but in the interim, we'll talk about the management. So management is quite interesting at this company. You want to talk a little bit about that?
Yeah. So the owner or CEO, I shouldn't say owner, CEO and chairman was Robert Greenberg. He founded the company. So you may not remember this company, but he was the founder of a company called LA Gear. So they made shoes that were more stylish in the early 90s, and I believe he sold it and then started Skechers. And so Skechers, he owns Class B shares. So Class B shares are different from the Class A shares in that Class B shares have 10 times the voting rights. And so he owns more than 10% of the shares outstanding, but because of the voting power that he has gotten, he owns about 42% of the voting rights. And then another board member who is who actually controls some of the trusts that his wife and he have has another 20%. So together, he has more than 50% of the voting rights of the company. So effectively, what he says goes. Now, some people see that as a problem.
It's a risk, yeah.
As a risk, and I mean, there is certainly a risk that he could, do something that is not shareholder friendly.
Mm-hmm.
But the way I also look at it is, even though he has more voting control in the company, anything that he does that harms the company also harms himself, right? In some ways, that it would lower the share price. So, for him, it does make sense to to do shareholder friendly things, and I think the incentives are probably aligned.
Yeah.
For the most part, with his ownership structure.
So to that, I asked this question: has the management handled excess capital in shareholder friendly way?
So that is where I think that this is not as good as I would like it to be. They've authorized a $150 million share buyback
last year,
and they bought 2 million shares back so far, which is good. That's definitely a good start.
Yeah.
I would, with $950 million in cash, a lot of it is overseas, so it makes it a little more difficult to just, repatriate it to buy back shares. I would like to see them do more, right? If they could do a $400 or $500 million buyback right now, when if the stock price is low, which we'll talk about in the valuation section, I think that would be a bigger boost to earnings than than any other use of their capital right now. In a lot of ways, because their dividend payments they don't pay dividends, which is is fine. I mean, I think that's a growing company. They should be reinvesting in the business. But opportunistically, I would like to see them buy back shares. Not when the price was high at $40 a share, but in the low 20s where it's been the last few months. I think it's warranted to buy back shares.
Yeah.
So
Obviously, there's that growing capex that they're putting their cash towards, but this excess capital after that, you have 900 something, 50 million in the book. So shareholder friendly way of managing capital, buyback, investing in the capital, investing in the business, and there's excess capital going ahead and just buying, doing the buyback is a way that management can handle money in a shareholder friendly way.
Yeah.
Okay. So last question: is the management open and honest?
Yeah. So if you read their transcripts,
Yeah.
I don't see any issues about them sugarcoating things. They're pretty, reasonable about what they say. I think some people have had issues with them saying like, look, I want them to invest, or they said at the beginning of 2018, that they were going to, operating margins were going to increase. They also said that they were going to continue to invest in the company as long as they saw growth. And that's what they did. So some people interpreted that as, well, you said that the operating margins were going to go up and they didn't. I don't see it that way. So I don't see that there's any problems with them being honest. They are, seem to be fairly straightforward in, what they say. Mm-hmm. And they do what they say they're going to do. So I haven't had any issues reading their transcripts. Now, this is coming from their COO who does the conference calls. So their CEO is usually not present on the conference calls.
Interesting. I see. Let's move on to the valuation side of things.
Yeah.
We talked about the financials. We talked about the management. Now we arrive at this question. Is this company fairly valued?
Yeah, so I think, remember, when we want to, before we even do that step, let's make sure that we can, now that we've done this, can we actually estimate their cash flows into the future, right? I think this is a simple business. Mm-hmm. It's not, there's obviously some complexity to what they're doing, but they're selling shoes. I can understand the shoe market. Everybody has feet. They need shoes, right? Mm-hmm. So that it's not going to disappear, right?
I feel like this is a very Warren Buffett-like play.
Yeah. So they're doing a lot internationally that I think is very interesting, and they have a large population area that they can target, which is Southeast Asia, India, and they're conservatively financed, right? So debt isn't going to ruin their cash flow over a long period of time. So I think the answer is yes. We can you can estimate cash flows into the future. So now I would say we can do a valuation.
Sure. Yeah.
So let's start with the
some of the assumptions.
Yeah, the assumptions that we're going to go with here are, I started with $270 million as the cash flow.
Yeah, we talked about that earlier.
Now, the company has been growing at about 17% a year for the last 5 years.
The top line.
Yep. Right? I am not saying that that's going to be going into the future. So I'm going to say that it's going to be more like 10 to 12%.
Okay.
So at a 10 to 12% growth rate, right? You see me using estimates, right, for everything. The 270 number is a conservative estimate. The growth rate of 10% is an estimate, right? If I use that number of, let's start with 12%, I get about a valuation of $40 a share.
With a discount rate.
With a discount rate of 10%, which I never change the discount rate. So people use that to account for risk and blah, 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 blah. No, I'm 10% is my number. I use that number because I think that is the reasonably safest return I can get, which is the S&P 500 plus dividends from the S&P 500 is 10%. So that is my safest investment. Now, Buffett would probably say, well, why would I invest in the S&P 500 when I can put more money in my next best investment? So his discount rate may be 15%. So I tend to stick with 10%. It's an easy number, and it's actually, I fix that.
So those are the assumptions that you're laying out.
Correct.
Yep.
So $40 a share. If we assume a 12% growth rate and about $35 a share if we assume a 8% growth rate.
Interesting.
And if we take into account that they have all this excess cash that could be returned to investors in some way, that number can go up to about $43 a share. So what I'm saying is, safely, this is around a $35 to $40 a share without using cash. If they just hoard the cash forever, $43 if they do that. Yeah. So that means that's the intrinsic value that I'm assigning to it. But the margin of safety, the price below which I would be willing to pay, is probably around $22. Let's $20 a share. So that's half of the number that we're seeing. 50% margin of safety.
Yeah.
And so I feel comfortable with that number. But the current share price is around $25 to $26 a share, right? So it's a little bit expensive.
Yeah.
And again, we were using very conservative numbers,
Yeah.
right? I think the cash flow number is probably closer to 290, but I'm still sticking with my 270 number just to be cautious. Also, we're using 157 million shares outstanding, which if that share buyback were to be exhausted, I think the number would be closer to 153 million. So they didn't put a timeline for when they would buy back all their shares. So let's continue to use that 157 number.
This is, again, if you guys don't know what Hari is going through, he's going through this kind of cash flow analysis. And if you don't know what that is, please do check out our podcast on discounted cash flow. We talk about what it is, and we take you through the formula itself. And so that's what Hari's doing here, laying out all the assumptions. But I think an important thing to remember here is that discounted cash flow is not exact science.
Yeah.
And so, like Hari's talked about, it's a range. It's all these estimates. And so you can really fudge the numbers however you want to by changing the assumptions, by changing numbers here, changing numbers there. So what's important to understand here is that $20 threshold that you talked about with 50% margin of safety, that's a conservative estimate, but also it's not an exact science.
Yeah.
So it's important for you guys to remember that when you do this yourself.
Yeah. So and I think the importance of the margin of safety here is if you are wrong in some of your estimates. Let's say that they only grow at 7% a year instead of 12%. Well, then your margin of safety maybe, covers for a little bit of that, right? And that's why also we use the conservative numbers. We used the 290 number and we used a 16% or 15% growth rate because they've been growing at 17% a year, you can easily make these numbers say whatever you want them to say, right? It's on you to have the self-discipline to say that this is, a strict kind of what number I'm going to use. Yeah. And so if you do that, then I think you can, the margin of safety will protect you even more. Yeah.
I think I want to ask you this one question. It's interesting because obviously the trading price right now, you said 25, 26, whatever it is, it's still below the intrinsic price.
Right.
Why is that? Like, why is it? It's hard to explain why, but if you could speculate, perhaps why is it trading below that price?
So I think there's a couple things that are going on. There's a lot of uncertainty about China right now in the U.S. How is that going to work? Yeah. Skechers has about 10% of their sales are in China, so it does affect that could have a big impact on the company. Yeah. I think the market. If you looked at it last year, after they announced that they were going to lever up, operating margins were going to improve, the stock price skyrocketed to $40 a share, and then it's now come back down to $25 a share because they haven't levered up, because they were saying we're going to continue to invest in growth. As an owner of a business, I would love to have them continue to invest in growth because that means future profits will be higher. Wall Street didn't seem to think that was a good idea. They wanted to see profits now, not profits later. So to me, that means that the management is focused on the long-term business, which means I want to be focused. I'm more likely to agree with management in that scenario, right? Yeah. So long story short, all I would say is I don't know exactly why it's depressed. the thing is that Mr. Market, which we haven't, which we've talked a little bit about, gives you these opportunities. Sometimes, he quotes a price. The price may be a screaming bargain. It may be way overpriced. So what we are trying to do is buy when it's below that margin of safety price and sell when it's at, or near or at the intrinsic value price. And I would say that, Skechers traded in the last 3 years between those two numbers, right? It below the margin of safety price and at their intrinsic value price, or a little bit higher depending on, how conservative you are with the numbers. So, to me, that's very typical of almost every stock. Some will be well above their intrinsic value price for a long period of time. You look at Netflix or Amazon, but many stocks will trade, in this range, right, below and above. So you're in good company when you look at it. But what you're looking for is maybe you like this company, maybe you understand their business, but the price isn't right. So now they go on your watch list, and then when the price drops because of whatever reason, you can now look at it and say, yeah, this is still a good bargain, or no, and you pass.
So that is the valuation part of the checklist. We talked about the financials, we talked about the management, and we talked about the valuation in this episode. Again, I want to reiterate the disclaimer we talked about in the first episode, in the previous episode 35. That this is an exercise that we go through. At the end of this exercise, we don't want to give you an impression that Skechers is a good company or a bad company that you need to go and buy or sell. What you were trying to do is we're trying to go through this exercise with you so that you can do it yourself and come to a conclusion on your own. So don't take it as I need to go buy Skechers now, or I need to go sell Skechers now. So please keep that in mind. This is for entertainment and education purposes only. Okay, so that wraps up our checklist going through the analysis of Skechers. Do you have anything else to add before we close out, Hari?
No. So I think we're going to continue to do one company a week, and we would love feedback from you guys. We've started getting some good comments, and so any feedback is appreciated, good or bad. And we would love to hear from you. So. Find us on, you can email us at info@valueinvestor.org, and Twitter, Instagram, and just hit us up.
Look for Value Investor TV on Twitter or Instagram. All right, guys. Thank you all for joining. We'll see you on the next episode.
Thanks.